Welcome back to Simple Mind Space, your sanctuary for all things personal finance and achieving financial freedom. Today, we're diving deep into the heart of the market, navigating the recent turbulence, and uncovering the strategies that can guide you towards financial success, no matter the economic climate. We've all seen the headlines. The market's been on a roller coaster ride, soaring to dizzying heights in recent years, only to take a sharp plunge lately. It's enough to make anyone's head spin, especially if you're new to investing or feeling uncertain about the future. But here's the thing, panic is never a profitable investment strategy. The key to navigating market volatility is to understand its roots. And often, those roots lie in a simple, yet powerful concept: the relationship between earnings and valuations. When the market gets overly enthusiastic, it tends to overshoot, driving prices beyond what company earnings can realistically justify. It's like a child on a sugar high, running wild with unchecked energy. This exuberance can last for a while, but eventually reality sets in and a correction occurs. Think of it like a rubber band. You can stretch it, but only so far before it snaps back. The market operates similarly. Periods of high valuations like we've seen recently are akin to stretching that rubber band. The farther it stretches, the more forceful the snapback will be when it finally happens. Recent events, like the economic turmoil in Southeast Asia, have acted as triggers, setting off that snapback and causing the market to correct itself. But these events are just the catalyst, not the root cause. The fundamental issue is always the same: a market that has become detached from its underlying earnings potential. This might sound daunting, but here's the good news. A market correction can be a healthy event. It's a chance for the market to purge its excesses, to reset and return to a more sustainable trajectory. It's like a system reboot, clearing out the clutter and preparing the market for a fresh start. Now, amidst all this market chaos, what's an average investor to do? Should you run for the hills and sell everything? Should you bury your money in the backyard and hope for the best? Absolutely not. In fact, market corrections often present fantastic opportunities for savvy investors. Think about it this way. If you find a company you love, one with a solid track record, strong fundamentals, and a bright future, wouldn't you jump at the chance to buy it at a discount? That's precisely what a market correction allows you to do. It's like a 5-for-4 sale on your favorite stocks. The key is to be prepared. You can't just wander into the stock market like a lost tourist, hoping to stumble upon a hidden gem. You need an organized method, a system for identifying promising companies, and making informed investment decisions. Think about how you approach other important purchases. You wouldn't buy a house without inspecting it, researching the neighborhood, and comparing prices, right? The same level of diligence should apply to investing. One of the best ways to gain an edge in the market is to focus on what you know. Instead of chasing the latest hot trends or trying to become an expert in every industry, focus on areas where you already have knowledge and experience. If you've spent years in the retail industry, for example, you've witnessed firsthand the rise and fall of various brands. You have a sense of what works, what resonates with consumers, and what makes a retail company successful. That's valuable insight that you can leverage when making investment decisions. The same applies to your local community. You're likely familiar with local businesses that are thriving, that are quietly growing and expanding their operations. These companies often fly under the radar of Wall Street analysts, but can offer excellent investment opportunities for those who have the local knowledge to identify them. It's all about finding your niche, your area of expertise, and leveraging that knowledge to your advantage. Think of it like playing a game where you get to choose your playing field. Why choose a field where you're unfamiliar with the rules and the players? Choose a field where you have an edge, where you understand the game, and your chances of winning increase significantly. Now, beyond simply identifying promising companies, it's crucial to understand their financial health. This is where diving into the numbers becomes essential. You need to learn how to read balance sheets, understand debt levels, analyze earnings growth, and assess the overall financial strength of a company. Tools like my Stock Shop with Peter Lynch CD-ROM can be incredibly helpful in this process. They provide a wealth of financial data, allowing you to track key metrics and make informed decisions based on solid research, not just gut feelings or speculation. Imagine having a research department at your fingertips, able to pull up 10 years of financial data on any company instantly. That's the power that tools like the Stock Shop can provide. Remember, when analyzing a company, focus on these key aspects. Earnings growth. Look for companies with a consistent track record of earnings growth. Cash flow. Strong cash flow is a sign of financial health and stability. Debt levels. High debt can be a red flag, signaling potential vulnerability in a downturn. Valuation. Compare the company's price to its earnings and other key metrics to ensure you're not overpaying for its future potential. Once you have a solid understanding of a company's financials, you can start to assess its risk-reward ratio. This is where you ask yourself, if I'm right about this company, how much can I potentially gain? And if I'm wrong, how much could I potentially lose? Ideally, you want to find companies where the potential reward significantly outweighs the potential risk. These are the companies that can make a real difference in your portfolio, the ones that can drive your long-term financial success. Now, I know what you might be thinking. This all sounds great in theory, but what about the uncertainties in the market? What about the potential for a recession? Recessions are a natural part of the economic cycle. They've happened before, and they'll happen again. But they're not a reason to abandon your investment strategy. In fact, they can create buying opportunities that can supercharge your returns. Remember, the market is always looking ahead. It anticipates future events and trends, pricing them in before they even materialize. So if you wait for a recession to officially be declared, you'll likely miss the chance to buy stocks at lower prices. Instead of trying to time the market, focus on building a diversified portfolio of companies that you believe in, that have strong fundamentals and are well-positioned to weather any economic storms. And when those storms hit, when the market corrects itself, don't panic. Use it as an opportunity to buy more of those great companies at discounted prices, further bolstering your portfolio for future growth. Keep in mind, the market is constantly evolving. New companies emerge, disrupt industries, and create new opportunities for investors. The companies that dominate the market today may not be the same ones that dominate it tomorrow. That's what makes the stock market so dynamic and exciting. So stay curious, stay informed, and don't be afraid to explore new industries and companies. You never know where you might find the next big winner that can propel your portfolio to new heights. Here are the key takeaways from today's podcast. Don't panic during market corrections. They're natural and can create buying opportunities. Focus on what you know. Invest in companies and industries you understand. Do your research. Learn to analyze financial statements and assess risk-reward ratios. Build a diversified portfolio. Spread your investments across different companies and sectors. Stay informed. Keep your eyes open for new opportunities and emerging trends. Remember, investing is a journey, not a destination. It's a continuous process of learning, adapting, and making informed decisions. By staying focused on the fundamentals, developing a sound investment strategy, and remaining patient and disciplined, you can navigate the market with confidence and achieve your financial goals.